Hello, and welcome back to the opportunity stage for our panel discussion entitled Wealth Management, the Next Step for Embedded Finance. My name is Peter Fishman, and I'm delighted to be moderating today's conversation with Adam Green, CEO of YieldX, and Julie Coyne, President of DriveWealth, each of whom is leading the industry in delivering innovative API-based wealth management and investing trading solutions. We are pre-recording, which means during the broadcast of this session, our panelists will be available via live chat to answer your questions. So I encourage the audience to interact with us as the discussion ensues. So kicking things off, let's go around the horn and have both of our panelists introduce themselves in a bit more detail and discuss how each of you see embedded finance or even digital transformation in general impacting traditional models for delivering wealth management services. Adam, do you want to kick us off?
Sure. Thank you so much, Peter, and really a pleasure to be here with you all today. And Julie, nice to see you and nice to be on the panel. My name is Adam Green, and as Peter mentioned, I'm the co-founder and CEO of YieldX. And what we're doing at YieldX is really reimagining fixed income investing and completely rebuilding the infrastructure for fixed income and yield investing on a completely digital end-to-end platform. And what that means in practice is that we're opening up the opportunities to a much broader range of investors to be able to access what have historically been relatively opaque and difficult to access markets across the globe. And doing so in a format, of course, API first, but really in a way that syncs very nicely with embedded finance. And you're going to hear a lot from Julie today as well on what they're doing at DriveWealth. And we're, of course, thrilled and honored to partner with DriveWealth on some really interesting and innovative use cases around embedded finance. But we'll get into that further. So for now, I'll pass it over to Julie, who can give her intro.
Hi, thank you, Adam, and thank you, Peter, for having me here today. It's a pleasure. So I'm Julie Coyne. I'm president of DriveWealth. My role is to help the organization scale through our next phase of hypergrowth and anticipate how we can deliver more for our partners. Day-to-day that spans operations, business development, sales engineering, partner solutions, marketing, HR, tech, and more. DriveWealth was the pioneer of fractional trading in U.S. equities back in 2015, and now we're the pioneer of embedded investing. We're a future-focused technology company that empowers our partners around the world to engage their customers by placing the markets in the palm of their hand. We're also innovators working with partners to invent new ways to use their technology to increase stickiness and enable consumers to become owners on their own terms and under their brand. And so we think embedded finance is having a significant impact on the traditional models for delivery of the wealth management services. So making investing affordable and accessible puts significant pressure on costs. Fintechs are not hampered by the excessive costs and other burdens and the general lack of agility of legacy infrastructure. And so our partners have launched low or no fee models in countries around the world and are providing what is often first-time access to invest via mobile device in fractionals in U.S. markets. Embedded investing in other experiences like payments or shopping, especially when a provider has a digital wallet, makes it easy and frictionless to open an account, fund it, and with our technology, they can have them start trading in minutes, less than 2 minutes with very, very little money. Most of the legacy players out there still have $1,000 or even higher minimums. They were built to be product-centric and have built layers of technology to aggregate data and get to the 360-degree customer view that is the foundation of most of the fintech companies that we work with. This is very expensive and it's complex. They often have spaghetti-like architecture. And some of the biggest legacy players out there, they only release digital upgrades 4 times a year. Whereas our partners built on our platform with modern tech stacks are very customer-centric, they're data-focused. They're launching new features and functions every 2 weeks. And they're constantly A/B testing to drive continuous improvement to personalize offers and experiences.
That's great. Thanks, guys. Julie, let's stick with you for a minute. You raised some really interesting points. I saw today that in a Kiplinger article that more than 10 million new brokerage accounts were opened last year, many of which were from first-time investors. And for the past several years, wealth management-focused fintechs have been leading this so-called democratization of wealth management. For example, the rise of robos and players like Acorns and Robinhood have offered access to wealth management services to a broader segment of consumers by, as you point out, lowering account minimums, driving down fees, and lowering the cost to serve. So, in your view, what are some of the most important innovations, technological, process, integrations that have been contributing to this democratization trend?
Sure, great question. Democratization to us, I mean, that is DriveWealth's mission statement. So, and to us, it starts with access. We want every mobile device on the planet in the hand of everyone to give them, access to investing, regardless of location, age, gender, income level. And that's how we get to a place of financial inclusion. And so, with more access and a more level playing field, we see the opportunity for entirely new experiences. And some of our partners have some amazing innovations coming to market shortly. But one of the key features of the DriveWealth technology platform is that we enable micro-share transactions. And this, coupled with the embedded investing technology, make it possible to target someone who doesn't self-identify as an investor. And so what we saw last year during the pandemic with all the new account openings is our partners are converting consumers into investors. And they do this because they're embedding investing in a consumer-like experience. It's somebody who doesn't think about, saving up $1,000 or $5,000, walking into a branch and trying to open a brokerage account. Our partners are making it frictionless, and they just want them to get started and get them engaged because engagement is really critical. Getting them started over that psychological hurdle of starting to invest, even just $5 in the market, is just the key. And that it's letting them open an account and get started with a psychologically unimportant amount of money is really what it's going to take to drive continued engagement with this segment. And our partners are using artificial intelligence and machine learning to engage these investors, teach them, and help them build wealth over the long term. So it's really exciting to be a part of this.
That's great. Adam, same question to you. What are some of the technological or process innovations you've been seeing?
Yeah, so Julie hit on a couple of really interesting points, specifically around financial inclusion and user experience. I think that they're inextricably linked in a lot of ways. And the reason why that is, now DriveWealth really did pioneer the fractionalization of the equity markets, which opened up a lot of historically folks that had not been investors to putting capital at risk to better their financial lives. What we're doing at YieldX is really along the same lines, but with a slightly different approach in a large asset class of fixed income, because historically fixed income has really been an institution to institution asset class, with ultimately the end user being at the end of that value chain. But we sort of think about it in terms of the push versus pull model in terms of what's happening in embedded finance and what technology, analytics, and sort of that real-time feedback loop facilitates in terms of that financial inclusion and the ability to personalize these outcomes for investors at scale. And so the push model historically with asset management was that the incumbent would create a product that they thought, based on a number of factors, would fit within the portfolio or investment objectives of the largest number of potential investors worldwide. And then they would have to make that as sort of homogenous across the board as possible to be able to sell to the greatest number of people. What embedded fintech is helping facilitate, and very oftentimes in partnership with other large either fintechs or even what we're seeing more and more is retail companies with large user bases monetizing that user base through embedded fintech or embedded finance approach, the ability to get real-time demand from the customer, see what their needs are, and then through API, through technology, through analytics, create this feedback loop with folks like YieldX, like DriveWealth, and many others to give a real-time view of what the market demands. What that then enables folks like us to do is create products in a much more scalable, much more personalizable, much more user-friendly way, because we can actually pull that demand criteria from the market, from our partners, from different platforms, and give them what they want, what they need at the point of need. So it really is a whole sort of ecosystem of sort of factors that create the ability for fintech companies and to engage in this embedded finance revolution that we're seeing. So we're really excited about that.
That's fascinating. So beyond democratization, how are trends in digitization and, if you will, API-ification of wealth management sort of changing the game for more traditional consumers of wealth management, so older and more affluent investors? Is this really just about empowering fintech startups to meet the needs of new to investing consumers, or is there something for everyone, including advisors and and family office professionals? Adam, let's stick with you on that one for a minute.
Yeah, sure. So the way that people have historically engaged with their investment life cycle has categorically changed. We saw it very much so over the pandemic with the retail revolution and what happened with a lot of stocks in the equity markets. But more broadly, the digitization and the ability of APIs and different sort of protocols like that to facilitate real-time engagement with a much broader range of asset classes means, number one, personalization at scale can be done much more effectively and efficiently. So we live in a world right now where everything about our lives is converted into a data point. People can have their own views on that, but we believe that it is reality. Every micro interaction we have with the apps on our phones, with the websites on our browsers, it all feeds back into sort of this profile of what we, who we are as people, what we do with our lives, our lifestyles, and the ability to use that data for good and to give people opportunities based on what that data shows is really what the future holds for financial services. And it's not just fintech platforms that are taking advantage of this. I mean, a perfect example is we saw this past year, Walmart, which is arguably, the largest retailer in the world, that has started looking at becoming sort of a version of a fintech by monetizing their incredibly massive customer base and their even larger database to be able to facilitate financial products for a very wide range of people across the globe. And so the digitization of all of these aspects of our financial lives can really tie into helping us achieve our goals much more efficiently and, most importantly, in a much cheaper fashion.
Great. Julie, same question for you. Is this just about bringing new entrants, new to investing customers, or is there something for everyone?
No, I agree with everything Adam said, and he and I have had this conversation many times when we were getting ready to launch, the products that YieldX is powering for us. So, he's right. I mean, the future is fractional. We don't actually think the future of investing's been invented yet, but the key driver of it is really the personalization that technology and APIs are enabling. And so it's really this flexibility to create highly customized personal experiences and engaging, amazing customer experiences. And that's what our partners are specialized in, is really thinking and innovating about what makes the life of a consumer or an investor better and easier, and how can they teach them about managing their financial life across multiple products. And so we're seeing the Walmarts of the world, but we're also seeing telecom companies, other global brands, people who have large user bases, and we might not think of them as a financial services company, but they're doing the lending or the loans for, buying the cell phone or a cell phone plan. Or car companies have come to us and said, we have a huge loyal customer base, and it's how do we monetize the loyalty of our big brand aficionados? And can we do that with stock and investing? And the technology and APIs make it easy to embed that kind of experience in companies that you wouldn't normally think of as a financial services company. In terms of, yes, our partners are mostly going after the underserved and the unbanked and the people without a lot of money, but we're also seeing that a lot of wealthy people are opening up apps. So they might still have the bulk of their assets at one of the traditional providers, but they want to see what's new and great in technology and what the latest offerings are. It's fun, they're more engaging, and oftentimes the fintechs are giving them access to products like crypto or other alternatives that their legacy institutions don't offer. In terms of other API technology, it's also transforming it because it's making it much more efficient for financial advisors to service large amounts of customers and just create extremely customized portfolios for every individual client, and then just use technology to auto rebalance those portfolios all the time. So we think it's really for everybody.
Yeah,
That's
Julie,
great.
I just want
That's
to
great.
follow up
And
on something on you. Can I just follow up quickly on something Julie just said? Because it just reminded me. I was recently at a family office conference, and I've spent a lot of time in the family office space over the course of my career, both initially when I was more on the traditional Wall Street side of things, and beyond. But one thing that struck me, and of course, this is potentially anecdotal, but I thought it was really interesting that a couple of the panels that got the most attention at this family office conference that was pretty exclusively limited to families with $1 billion or above net worth. So those are people that have generational wealth from very large, diversified sources of capital that you would think would be pretty much focused on capital preservation in the context of what they know and what works. The largest attendance at the panels was on digital assets and financial apps. So, I really do think this is a tectonic shift in what we're seeing. I don't know that that would have happened 2 years ago. I don't think that pre-COVID, before the sort of public consciousness became aware of the phenomenon that we saw with platforms like Robinhood and all of these other retail trading apps, that despite the fact that everyone in that room either has a number of their own sort of trading and execution wealth management platforms that they've been using for a long time, or their own internal capacity, they're still hearing about things that are really capturing the public's attention, and they want to be, they want to be involved in it. They want to understand how it's going to impact them, how it's going to impact markets and trends, and we're seeing a lot of the fintech tail wagging the dog of traditional Wall Street. And a lot of the big banks and institutions and asset managers, we at YieldX have been incredibly humbled and inspired by the response we've gotten from a lot of the clients that we sell to who are those traditional financial institutions, because their minds have really opened in a way that we really truly didn't expect to happen this quickly. But it really speaks to the sort of maturation of where embedded finance has gotten to at this point. So I just wanted to throw that in. Hopefully that provides some color.
this is really interesting. So you're saying that members of families that have billions of dollars in assets are still finding inspiration in some of these tools, digital tools that sort of democratize even for them uh, these capabilities that they may have otherwise left to large Wall Street firms to deliver for them, but whether it's analytics or real-time trading and information. So interesting stuff. Julie, you mentioned in your answer about car companies and cell phone companies embedding other aspects of banking services like lending and payments. How do you see traditional investing and brokerage services also coming into into combo products, if you will, for brands or services that aren't necessarily directly related to finance? And is there anything that DriveWealth is doing to help enable that?
Yes, we are working with a number of these big global brands to. It's really about loyalty, right? So they've mastered the art of driving loyalty with their customer bases, but everybody's looking for something new, right? So I mean, you have Starbucks stars, whatever other points program that you have with your credit card company. How do you really take that and make it a more engaging experience that's going to get your people looking at your app or logging into your website every day? If you know what your cash balance is in your bank account, you're not logging into that more than once a week or when you have to once a month when you have to pay your bills, right? If you don't even have them on auto payment. So brokerage is, we always call it the holy grail of engagement. Partners on our platform have been able to drive 2 to 3x the revenue of those customers because of the investing. And while they may not always be making the profit margin on the investing, their data centricity, their models, they're able to monetize the eyeballs on the screen. And so we see, even customers that, our average trade size is $200 to $300. It's very small. And a lot of the partners have customers that trade much smaller amounts than that. But it's really the fact that every time they log in, they're looking at their screen, they're engaged, even if they're trading $5 a week. It's partners and brands and companies that are data experts and loyalty experts can really use those eyeballs on the screen to drive engagement. People check their app. They want to see what their balance is. This is the beauty of crypto, right? Crypto is one of the most democratizing, products on the planet. Got people of all ages around the globe, all wealth levels, engaged and doing something that they thought was cutting edge. And with some of the products that our partners are looking at with investing, they can do the same thing. And so, it's all about everybody wants something new, something engaging. And so that's what we're working with many of them on is how they can convert a loyalty experience instead of, swapping out credit card points for 20% off your next car rental, put it into a portfolio. If you had gotten $1 Starbucks stock instead of a free latte every time you went to Starbucks, you'd be sitting on a lot more money right now. And so I think that's
Okay,
really
so
the future.
and that's really enabled by sort of the fractional trading that you pioneered. So you brought up the C word in crypto, and I'll add in the B word, blockchain, which always I think in the past at conferences like this always got chuckles from the audience of whether they would really have their time. But crypto is really rapidly becoming pretty mainstream. Within wealth management, do you see this as a fad, or based on some of the things you're saying about loyalty, do you think it may be here to stay? Is it part of a sensible part of a diversified portfolio, or just sort of the flavor of the moment?
Yeah, we believe crypto is here to stay, but it's really, really, really early days still. Crypto and blockchain have excellent use cases. They can completely transform money movement and trade settlement. But when you think about a consumer experience, the blockchain technology processing speed is nowhere near what you can do with a digital wallet or a Visa card, right? And so and then when you think about financial services, anything financial services related that is or will become regulated, it's just really slow moving. And so when the technology advances, when people understand the valuation methodologies, because I think there's still a lot of confusion, even in the traditional, equities research and Wall Street communities about how to value these tokens. And then when legacy players move their infrastructure to T0 settlement, then I really do think the world of wealth management will change forever. So it's here to stay, but we're still in the very, very beginning stages of this.
Yeah, I
Adam,
mean,
anything to add on that?
absolutely. So I do agree with Julie that it is here to stay, but it's still very early days. And really, the way that we look at it at YieldX is the digitization of assets. And it doesn't have to just be the underlying currency. It can be yield driven as well, stablecoin yields. It can be fractionalization of real estate or other real assets. So that's really where we see the power and the potential going in terms of the application of blockchain. That's where we see the institutional investor community becoming interested, because the markets we play in at YieldX are the $200 trillion of notional annual volume that you see globally. Whereas you think about the market cap of Bitcoin, and size-wise, a single insurance company with a large balance sheet could trade that entire volume in a single day in the fixed income markets. And so there is a massive difference between where retail markets engage with digital assets and where institutional investors even can become interested. And it's important to also note that when you get into asset management more broadly, people tend to think of purely asset managers in terms of the big brand names, and then retail investors. But you also have to think about the massive market participants in insurance companies, pension funds, different corporations. The FANG stocks each have internal treasury departments that, if spun out, would be the biggest hedge funds in the world, right? So there are a whole wide variety of flavors of asset management. And when you start getting into these newer innovations and the application of that innovation across markets more broadly on a global level, I think people are going to want to see a lot more regulation, a lot more transparency, a lot more validation over a longer period of time before you get the adoption at sort of the more institutional levels. That said, we are working very closely with some very large institutions that are trying to figure out how to find their sea legs in this very new, very exciting space, specifically in the markets we play in. So, um, stay tuned in this space. There's a lot of innovation happening. There's a lot of really interesting opportunities. The thing that we always talk about is, especially sort of this yield risk spectrum that we at YieldX play in sort of the more stable, low volatility, fixed income space. Crypto and equities to some extent they have higher volatility, so people just need to understand what that means in terms of their overall investment objectives. I think that's probably why you're seeing a lot of the great success of platforms like DriveWealth, because you have this next generation of investors that really can take a lot more risk and recover from any sort of market cycle. Not that there's really been a cycle lately. It seems to be all up and to the right, but presumably at some point they will realize that cycles exist, and that a diversified approach is always the best approach for the long term. But there's no question that that the digitization of assets, whether it's crypto or other types of coins or digital assets on the blockchain, help people learn about what it means to own a different asset, what it means to own a piece of a rental property of real estate, or a piece of artwork, right? And at the end of the day, you have to be passionate about what you do with your money. Passion and goals-based investing drives a lot of people's reason for what they do. You're seeing that in ESG investing. You're seeing that really across the board. And especially it seems, at least from our perspective, that the younger generations have much more of a values-based approach. And so I think that these new protocols, the digitization of assets, the ability through DriveWealth, and others like them to buy fractional pieces of something instead of having to wait until you're much later in your investment life cycle and then make a decision, that really opens people up to learning more, and education really is the foundation to financial inclusion. So I think it's all linked.
That's fascinating. Adam, you mentioned in your answer regulation, and what in your view is the role of regulators in either encouraging or reeling in some of these fintech and financial services innovators in the area of embedded wealth management? Is there a risk that embedded wealth management strategies, are helping some organizations to avoid regulatory entanglements?
I think that if you look back over history, innovation is always initially met with some form of resistance from regulators. I started my career in the high yield bond markets. They were called the high yield bond markets by the time I got there, but before that, they were called junk bonds. And Michael Milken ended up in jail for creating this massive innovation that has since then really fueled economic growth objectively across the board on an order of magnitude that people could never have foreseen at that point. There have been over almost every cycle where you see massive innovation, regulators come in and they take an potentially an overly aggressive approach initially, because that is the right thing to do to protect people from bad actors. The question that I always have around regulation, and I don't, unfortunately, spoiler alert, have an answer to this, is what is the right level of regulation that sort of meets that nice point between stifling innovation and facilitating investor protection. One of the things that I think we're seeing in blockchain specifically, we're based in Miami. The Mayor Suarez has been a massive proponent and advocate for innovation around blockchain. The United States is really a country of 50 countries from a political perspective. And so each state has their own regulatory framework and views. And then, of course, the federal regulators have their own views, and they can oftentimes conflict. And, as a huge proponent of American capitalism, I would like to see a much more cohesive effort across the board to come to the table and really put sort of a think tank together of people that are participating in, creating that innovation and participating in it from an entrepreneurial standpoint day to day, and from the regulators and the lawmakers and, even the educational systems. I think that there's so many different pillars of what goes into educating people about different products. It really starts at an early age, and then really creating a framework where you don't have companies running away to Asia and other areas because they have more carte blanche to innovate. So we have to do whatever we can to help support educating our legislators and politicians to understand why we're doing what we're doing from an innovation perspective, be as transparent as is rational and collaborative and supportive, so that ultimately that filters back down into the innovation stream, and lets people do what they need to do, but do it in a framework where everybody is on the same page with where things are headed and how, to put bumpers on the lanes.
Julie, anything to add?
No, I think Adam nailed it. We do this all the time. We work with regulators around the globe to make sure that they understand what fractional equities trading is. And, I think a lot of times what people think about in terms of sanctions around certain countries and what the view of a government might be, we think very differently about the retail investor. So there should be no real risk with somebody sitting in Nigeria or Indonesia or the Philippines buying $5 of Amazon, publicly traded stock. And especially when it's not their life savings. It's better than going to a traditional brokerage house where you have to take your life savings or your retirement and bet it on black and put it into the market. And so, being able to penny cost average into the market, that is not the risk. And with technology, innovation, and all the new identity verification tool sets and providers out there, it's getting easier and easier to make sure that we've done our AML and KYC homework on these individuals. And then it's really just having a risk monitoring program just to make sure that it isn't fraud or a bad actor, making $5 transactions over, 2,000 fraudulently opened accounts. That's really where the risk management comes in. But our goal is to break down country borders. We think anybody anywhere should be able to invest in any product around the globe, as long as they're educated, like Adam said. So, when some of these new innovative digital assets that are not asset backed, maybe the valuation methodology is not well understood. Maybe that is risky for people to be able to invest large amounts in, but they should be able to invest $5, $20 in that just to get started and to learn as they go. And what we think the real future is creating a true exchange of things where you could go into a website, for sneakers and create your own sneaker token and sell it to somebody and exchange it straight on a blockchain platform for a government U.S. currency-backed token. And so that's where we think that this could go. And I think having anything that's truly asset-backed on the blockchain has a lot less risk in the future if people understand what the actual underlying asset class is. And so it's really, education, getting people started and teaching them as they go so that they're not losing their life savings trading something that they don't fully understand.
It's amazing to think where the technology can take us. You've sort of started to answer my next question, so I'll give you the option of answering or passing. But what are your earlier you said, Julie, we don't even know what the future looks like for embedded finance and wealth management. Any predictions on what's next to come?
Yeah, I mean, we're excited. Our partners have so many creative design teams and product teams that we get to work with every day. It's really exciting. And I think the foundation is really that they're so customer obsessed and data centric. And I think the future is going to be, like Adam had said earlier, highly personalized, AI driven. I think the creativity around what an investable asset is and what can be tokenized, we're just early days. And so the real beauty of what our partners are doing, what DriveWealth and YieldX are trying to do with our technology is making sure that, we can pivot. We want to have the speed and the tech stack that's industrial proof so that no matter what they invent, we'll be able to power it and be able to get them to market faster than any legacy institutional tech stack could, so that they can really create the products for the new younger generations or the underserved and the unbanked. So I think it's hard to predict, but we know that what we deem to be an investable asset today is definitely going to be redefined over the next decade.
Awesome. Awesome. Adam, same question for you. Take us home.
Absolutely. So, along the lines of what Julie was saying, I mean, personalization at scale is really just at its infancy stage as well. So, we're built on a completely microservices architecture, and our APIs, of which there are, I believe, over 300 right now that we have. Um, Anyone that wants to innovate around the services that we offer can pull any of the services from our stack and create their own experience, their own products, their own path that they want in terms of new product innovation, new application for our systems, new risk models, new investment models. So, um, the innovation, I think, is going to become really geometric in its growth. And with such a data-driven economy and such a data-driven technology-based financial ecosystem, we have just barely scraped the surface. I mean, what has happened in the past few years with fintech broadly, and then with the maturation of fintech becoming embedded fintech within other industries, um, you know, the fintech ecosystem really spawned from wanting to apply technology to solve big problems in traditional finance. That's what I sort of envisioned with my team at my prior company, Moneyline, who took on sort of the disintermediation of the traditional banking system. Doing the same thing here at YieldX with applying technology to create automation and transparency and efficiency around the different pillars of fixed income investing. Um, but when you think about all of the different industries out there and the different ways that customers engage with brands and the way that finance can play a role into how they monetize or incentivize or acquire their customers, it's almost every day now that I'm seeing things that are just completely fascinating and if not outright mind blowing in terms of how people are leveraging the data around what their customers are doing. So, we're really excited about the future. I think that, we always like to encourage people to think really big, especially when you're dealing with your personal investing. It becomes a very emotional thing. So financial education is something that we think is absolutely essential so that as new sort of innovations emerge, people can figure out where they want to live on that adoption spectrum. Are they a first mover? Do they understand what it means to be a first mover and the risks and rewards associated with that? Or do they want to take a pause and see how things play out and test the waters a little bit and maybe invest 5 or 10 or $20 into a stock before you really go all in, and folks like DriveWealth can help facilitate that. And then, of course, YieldX will be here to make sure that for the other part of your portfolio, everything's stable and cash flowing.
That's terrific. This has been a fascinating conversation. Thank you both for spending the time with us and talking through what might be next for embedded finance. So, Adam, Julie, thank you very much. Stay
Thank you.
tuned right here on.
Thank you.
Absolutely. Thanks. Stay tuned right here on the opportunity stage for the final session of the day, which is a fireside chat on the creator economy, which is scheduled to begin shortly.